This is Tier 5, selecting the optimal strategy. Cluster 1, how to trade long calls. And this presentation is trading out of the money calls. Now before I get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. And you can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago, Illinois. So this presentation specifically addresses out of the money calls. And we will discuss when it's appropriate to use an out of the money call instead of an at the money or in the money call. As a quick refresher, an out of the money call is when the stock price is trading below the strike price. Out of the money calls can be relatively inexpensive. They're certainly cheaper than in the money or at the money calls. Out of the money calls are all time value. They don't have any intrinsic value at all. So they have a low cost, and they also have a low delta. That is, they don't move very much in step with the underlying stock. Stock can go up or down $1, and the option might change something much less, a dime or 20 cents or 30 cents. Now, because out of the money calls are all time value, on the one hand, they have a low amount of time decay because their value is low, but on the other hand, being all time value, their entire value will decay by the time expiration comes around, unless the option is trading in the money and therefore has some intrinsic value. So therefore, out of the money calls can be thought of as pretty speculative. They have a lower chance of success than in the money and at the money calls because of some of the things we've just talked about. But when the trade does work out, the trader can really kill it. They can have a highly leveraged profit. Compared to at the money and in the money calls, out of the money calls have the lowest amount of premium at risk, and compared to the strike price, the closest break even because of their smaller value. However, the stock price is below the call strike price when it starts out, so the break-even point might be significantly far away from the current stock price, meaning if the trader holds the call all the way until expiration, the stock will have to rise a great deal to make it through that break-even point. Now, a lower premium compared to at the money and in the monies means there's less actual premium that is at risk. So you can see the trade-off that comes along with all option strategies very prominently shown here. Low chance of success means low total risk and very high total reward. That is why out of the money calls can be thought of as a speculative leverage strategy. Out of the money calls are ideally suited when a trader is expecting a major breakout to the upside. Traders who trade earnings probably use out of the money calls. Traders who trade story stocks, where there's something going on in the stock and a volatility event is expected, a trader would buy an out of the money call to speculate to the upside. It would have better profitability and better risk reward than an in the money or at the money call. Now the money call would be used to speculate on a huge directional breakout. If we're looking at a chart like this and we're expecting that green bar day to happen, that green candle day to happen, we'd buy an out of the money call. Now, an out of the money call is not an investment strategy. It's a trader's strategy. In fact, it's an active trader's strategy. This is for traders who are engaged in the market on a fairly regular basis. A trader who a few days ago was looking for a pretty good breakout and then, lo and behold, 2 candles ago, these are daily candles, 2 days ago, the market gives that breakout to the upside, and it's a pretty strong one, would have done very well with an out-of-the-money call. This type of expectation is ideally suited for out-of-the-money calls. So we look at an option chain of Coca-Cola trading in this example at $68.31. So the stock price is between the 67.5 and 70 strike. Therefore, the out-of-the-money calls would be 70 and above. All the strike prices that have a greater value than $68.31. Now, the strike prices are higher numbers, greater value, but the option premiums are smaller values. 70s are only 33 cents. The 72.5s are only 7 cents. 75s are only 3 cents on the ask. So they can have very, very small values, but they have very, very high leverage. So when the trade works out, the calls can go from 7 cents to 50 cents. You can make many hundreds % profit when the option works out in your favor. And again, the odds are a little bit against you, but the payoff's there when it works. The clearest benefit of an out-of-the-money call is its small expense. That's why traders sometimes refer to them as lottery tickets. They have that small expense, they have that high leverage. Now, an option that's trading at 7 cents can only decay 7 cents. So its theta is very, very low, especially compared to an at-the-money call. This leverage comes at a price. It's the low chance of success. And the chance of making money on this trade is low. And that also implies that the chance of losing 100% is greater with an out-of-the-money call than it is with an in-the-money or at-the-money call. Out-of-the-money calls can be an ideal option strategy under the right situation, as long as the trader knows what that situation is. This has been a presentation of Market Taker Mentoring.